Yeah, look, notwithstanding that historically this is the best period, your November through to March, April period, accounts for the bulk of your returns year in, year out. Notwithstanding that, the market's not behaving at the moment as we'd expect it to. The price action is not what we'd like to see. So we're taking a more cautious view. We've still got some good, solid, high conviction positions, but across the board we're taking a more cautious view and we've increased our cash levels to just over 30%. Yeah, so there's a whole variety of things. First, if you look at the debt markets are showing signs of stress. And some of the credit spreads are blowing out, and that to us is often a good lead indicator. Volatility, of course, in August we saw the highest level of volatility since 2011 and the highest level of volatility on an intra-month basis since 2008. And again, volatility is often that canary in the coal mine. So it does to us say that we want to be just a little bit cautious than we otherwise would be.
So these sound like they're the symptoms. What's the source? What's the cause of what's making people nervous?
That's a really good question, because often you have the cause first and you look for indications or symptoms to follow. This time it's almost the other way around. You can see some things that could potentially create a problem. You can see rising interest rates after a decade in the US. You can see what's happening in China potentially. You can see some of the emerging economies like Brazil and the stresses that they're experiencing. But if I was to sit here today and try and pinpoint one thing, I think it'd be a bit hard to do at the moment. Yeah, look, we highlighted on Livewire actually, early in the year, the massive differential between the performance of the small cap index and large caps. So what we're seeing now is part of a natural reversal in that. It's been probably a 5-year underperformance, and so we're starting to see a bit of reversal there where small caps are starting to catch up on a relative basis. I think added to that though is there's some specific thematics which are impacting our big caps, whether it's the banks, which most people consider ex-growth, whether it's the retailers, which most people consider coming under record levels of competition, whether it's the resource stocks, BHP, Rio and the like, which have got this clear set of problems. I think in that top 10, 20 category of stocks, there's some individual issues that are confronting each of those sectors. And it's hard to see those specific issues subside anytime soon. Look, it's interesting. I think we're looking at it again, and we've had zero weighting for a long time, as you're probably aware, but we are looking at it again purely on the fact that the price has retraced so far. So from a valuation pricing perspective, it's starting to look interesting. From a timing perspective, we still think it's too early. We still think that the commodity complex is not showing signs of recovering, the pricing, and we still don't see signs, serious signs of the supply side abating and normalising. So from our end, yes, the price action is really interesting, and there may be an opportunity for a short-term trade, but we still see headwinds in the form of pricing for commodities.